All right, so we're about a minute away from starting off, and I just want to do a quick sound check. Todd, can you hear me?
I can hear you fine.
Awesome. Thanks for joining us.
Sure, my pleasure. Nothing else to do.
I'm sure that's not the case.
No.
But certainly better than watching the news.
Oh, the news is just drives you crazy.
So I'll take a moment to introduce our session here. For those of you I don't know, my name is Charlie O'Donnell. I am general partner at Brooklyn Bridge Ventures, which is a seed stage and pre-seed stage fund based out of New York. It's a generalist fund. We do a very wide range of different types of companies. I've been in this asset class since 2001. When I first joined venture, I saw 10 negative quarters of performance before I ever saw a positive one. So I've been around for a few cycles, not necessarily as a partner throughout the whole thing, like Todd and Brad, but excited to hear what they have to say. Todd, do you want to give us a short introduction?
Sure. Well, I joined the venture capital world about 26 years ago. And I started with Battery Ventures. I was there for about 9 years. And then I founded Spark Capital about 16 years ago. And since then, we've raised about $4 billion. We just closed 2 funds, a venture fund and a growth fund, at a total of almost $1.4 billion. And so we have $1.4 billion of dry powder. And we're looking at this situation right now kind of as a huge opportunity, but at the same time, you've got a portfolio of 138 companies you have to deal with.
Gotcha. So just to kick us off, and we'll bring Brad in as he joins. So founders right now aren't even totally sure what they should be prepared for. I think we all find ourselves playing amateur epidemiologist and economist right now, trying to guess, when can we leave our homes? When will people start to feel safe going out? Just as a place to start, what do you think is a reasonable assumption for a founder to make right now? As when, like, if my business was betting on like life getting back to something like normal, just putting aside whether we're going into a recession or not, like, how have you been advising companies along those lines? What's a reasonable expectation?
Well, I mean, I think getting back to normal, doing business normally, I think we're probably into June. As far as doing business normally, people being able to go into their offices and working normally. Until then, it's people telecommuting and working virtual teams, and we're a lot better off now than we were in the last downturn and the one before that, because people have been more accustomed to working virtually. There's plenty of tools available. So I think people are going to be more productive this time around.
Gotcha. Brad, thanks for joining us. Before I have you answer that question, would love a quick intro. Although I think everybody probably knows who you are.
Brad Feld. I got into venture in 1996. Before that, I made a bunch of angel investments with my own money and had a software company before that I sold in 1993. The first firm I was part of was originally called SiFiveand Technology Ventures. Had a very auspicious title given the dynamics today. And that firm eventually, we were spun off from SoftBank. We eventually rebranded as Mobius Venture Capital. And we ultimately had a very entertaining time in the ride up of the internet bubble. Extremely positive for about 3 years and maybe 4 years, and then a disastrous experience in the collapse of the internet bubble in 2001 and 2002. In 2006, I co-founded Techstars, which now has about 350 employees and runs 50 programs around the world. We do about 500 investments a year. And I'm on the board of that. The other co-founders, David Cohen and David Brown, run it. And the fourth co-founder is Jared Polis, who's the governor of Colorado now. And then in 2007, I started with three of my partners or colleagues from Mobius Foundry Group. We've raised a number of funds over the years, like Spark. We've got about $2.5 billion under management. We invest 75% of our capital in companies and 25% in other early stage venture funds. We've got about 30 partner funds that we've invested in, most of them sub $100 million funds, but some of them hard to access funds with people we've been friends with for a long time, like USV and Founder Collective. And Foundry and Spark have a long positive history together. We've had a number of companies that have been very successful, and you know, I have immense respect for Todd and his partners. And one of the origin parts of the Foundry story is our very first investment that we made when we raised Foundry's first fund in 2007 was Zynga with Union Square Ventures, and we paired with them on that. And the very second deal we did was AdMeld, which we partnered with Spark on. And so have incredibly warm feelings about both firms because they help put us on the map in a big way.
Cool.
I live in Boulder, Colorado, and I am perfectly suited for work at home or work from home because I generally do that anyway because I don't like to go into the office. And this way I'd only have to shower 2 or 3 times a week and shave when Amy finally says it's time to shave.
Cool. So Brad, do you think June, you know, Todd mentioned is sort of a, you know, when does life start to return to normal? Assuming it's not some dramatically different new normal, is sort of a reasonable time frame?
Yeah, I think the way Todd said it, which I didn't think, I was jumping on and off my Zoom room onto this because I had the wrong code in my calendar and it wasn't refreshed. I don't think Todd said it will return to normal in June. I think, Todd, you said that's the earliest we should expect it to.
I think that's the earliest people are going to be able to go back to work and operate fairly normally.
Yeah.
I think there'll be pockets that will still be probably, you know, having to be more limited, but I think that's when people will be working again from offices and traveling and things like that.
My cookie angel just brought me cookies. So yes, I agree very much with what Todd just said. Although I'm framing it slightly differently. I believe that between now and the end of April, we're in this mode that we are in now, which in Colorado is starting to become called the surge. And I'm involved in a number of initiatives at the state level, private sector task forces. And I think the general view is everybody is right now all hands on deck to try to get in front of the surge so that we can get to the other side of that, have our hospital system and our patient care system not collapse, and be in a place where we have the ability to then deal with what will be a longer dynamic of dealing with COVID and adjusting our reality. And so my mental model is between now and end of April, just all bets are off. Like just hunker down and do everything you can as a human being to help your fellow human beings around you in your community and in the various networks and companies. Companies should make, you know, situational awareness and really understand what they've got to do with what resources they have and what's happening to them in the current environment. You know, interestingly, some companies benefit from this. Many companies don't, but there's not a generic all size fits all. We know the federal government is going to flood and is flooding the system with huge amounts of essentially interest-free money or extremely low-cost money, and there's no inflation. So my general view is fuck it, print the money for now, and deal with it on the other side. I think we then enter a period, May, June, where things will change and we'll have a lot of understanding of whether we got through this surge in the United States or not. If we do, I think we will start to have a summer that people in the US recognize as something that resembles summer. If not, I don't think that's going to be true. That's going to continue to push out. So I think we're in a very critical moment right now where for that to happen, we have to really focus on doing a bunch of things personally in our communities and with our companies in a way that's very effective in this environment.
Do you guys think that founders today, Todd, you brought up from a tools perspective, I was thinking today about, how would this have been in 1999's video bandwidth and technology and all that sort of stuff? It would have been obviously incredibly difficult, but just from a founder mindset, I think, I look across like who is founding a lot of these companies, and, many of the founders running these companies weren't around for 2000, maybe too young and weren't adults during 9/11. And a lot of them might not have even been in the workforce during 2008. So do you think that founders are like mentally prepared to go through this, and what can they do around those lines?
No, I don't think they are. I think it would be really hard to be prepared for this unless you've been through a couple of them, or unless maybe you've been to battle overseas. I don't think you're prepared for this kind of a thing. One thing about these young founders is they're not afraid of anything. That's why they do such amazing things, is because they'll go take incredible risks and they'll just focus on the upside, and they'll do things that other people think are crazy. And that's why we are able to build amazing companies in this country. It's because of that lack of fear, and then that, that ambition. But I think now is when, you really have to take stock of the situation. And this is not going to go away tomorrow or the next day, or it's just going to linger for a while. And you just have to make some really hard choices right now. Unless you're delivering at-home fitness equipment or video conferencing services or, PPE, you are not in good shape right now. Some of the grocery chains are doing okay and elsewhere, but for the most part, what's going to happen here is there's going to be a lot of disruption. There's going to be a lot of confusion, and it's a time when it's going to be very difficult to raise money. If you think there was a flight to quality this past 6 months when people got nervous, wait until you see the flight to quality now. There will still be companies raising money at good valuations, but very, very few. And most companies are going to find it much more difficult to raise capital. And if they do, they may not like the terms. This is when the knives come out right now. And, particularly if you have investors that are licking their wounds and dealing with all of these portfolio companies that need to raise money and need to cut, then you want them to take a meeting with you because you need to raise money. I mean, it's a challenge.
So Brad, Todd mentioned fear and fearlessness. Is fear right now a good or bad thing for a founder?
Well, I live by the rule of doom and Frank Herbert, which is the line that fear is the mind killer. So I actually don't view fear as a particularly constructive or helpful emotion. I think that and to act on, I think recognizing that you're fearful of something is very helpful to cause you to then look at the thing that is causing you to feel fearful, and then make thoughtful decisions about it. But if you're reacting out of fear, right, you will often make random and irrational or hurtful, harmful decisions. And so I think the contextual dynamic, without being too philosophical, like the contextual dynamic of it is everyone has massive anxiety right now. The person who says, oh, no, I got no anxiety, I'm totally cool, they're full of shit. And anxiety impacts people in very, very different ways. Some people are very aware of how anxiety impacts them. Other people aren't. And in my own experience, fear is a result of anxiety. And so when you sort of walk your way back from the emotion of being fearful, and you then shift into an intellectual mode, back to what Todd said about, look, if you're a company that relies on, for example, people traveling, or you're a company that relies on people going to work, you're kind of fucked right now. And so you can be afraid of things, or you can say, okay, what do I need to do rationally against that backdrop to survive? What are the hard things that I have to do today? And you've seen it in some very brave moves by large companies in the restaurant business that very aggressively said, look, I can't afford to have 1,000 people on my payroll across all these restaurants. Today, I'm shutting everything down, and I'm trying to figure out how to now be part of the food delivery chain. And I'm going to try to rehire people back. Here's a month's worth of pay because I can do that, because I have the wealth to do that. But I'm not going to be caught up in fear. So try to use it to motivate you to focus on the thing that is causing the challenge, causing you to feel that way, and then aggressively take action.
Gotcha. And how would you suggest, Brad, that founders check in with themselves on their anxiety and those feelings?
Well, let's put founders in a couple of categories, and specifically founders here. Okay. So there's a group of founders that have a very well developed network for themselves emotionally, whether that's peers, whether that's coach, whether that's a therapist, whether that's family member, significant other, whether that's an investor that you have or investors that you have a very sort of emotionally accessible relationship with. That's one category. I think those folks know what to do. Just keep doing what you're doing, but recognize that everybody that you're interacting with is feeling the same anxiety that you are. And so their capacity to interact and relate to you the way they normally do is probably somewhat limited, right? So that empathetic investor that you have might miss a beat because, she is in the midst of her own shit show as she's trying to sort out what's going on. Middle category, people who are emotionally accessible as founders, but don't necessarily have that network. Simple advice, find the network right now. They're spinning up everywhere, they're available. Lots of people are trying to engage professionally in that. Look through the existing networks you have to find people to engage with at multiple different levels. Don't do it randomly. Like, again, sit back and say, gosh, it would be really good to talk to 3 other CEOs about what I'm going through right now. Or if you're a technical founder that's in a business that all of a sudden there's no business, but there's a lot of pressure to, okay, well, we got no business, but we're going to go fix a whole bunch of stuff because we got no business. Find a couple of other technical co-founders that are in that same kind of environment. If you're early stage, find some other early stage ones. If you're late stage and you've got, a big company that all of a sudden has seen a huge drop off in business, go find similar people like that. So look for your peers to relate to. The third category is the one which when I was an entrepreneur in 1987 didn't exist, or is the only category that existed. Today is not, is the entrepreneurs or founders who don't have either of these networks or self-awareness or a recognition of the value that these could bring to them. And my encouragement for that group of people is to just be open to it. Recognize that there's probably a lot of people that are 1 degree of separation around you that are willing and interested and able to help you. The last comment I'll make is I find when I'm in situations of crisis that if I think about myself last, it's not at all. I have to think about myself because I have to have energy and you have to be able to get through things and you have to, take care of yourself. But if I put most of my energy into helping other people, my anxiety level personally goes way down. And I've seen this with a number of founders who are great leaders who, when they're in a situation like this, they don't spend their time worrying about, oh my God, am I going to lose all my money? Oh my God, I thought I had a net worth of this on paper and now it's all going to go away. Oh my God, we have all these office leases that, are going to be empty. Instead, sort of turn it around and say, okay, I've got 1,000 employees. How am I going to deal with what their needs are? Okay, we're going to lay off 500 people. How are we going to deal with making sure that those 500 people get laid off? We can't give them very much money. What other things can we do? Like turning your focus around so that you're taking action often helps you find more peace in what's going on.
Cool, thanks. So when will you start to get back to work and hopefully if the surge is successful, Todd, do Are you advising your companies on expectations? You mentioned sort of a flight to quality on what kind of a macro environment in general to expect?
Yeah, well, the thing is, after the surge comes the purge, unfortunately. I mean, we're into 11 years of kind of a bull market and a very kind of ripe market for starting companies. And there's a lot of companies out there, and there's a lot of capital too, but that capital now is a little bit confused and trying to figure out what to do. So I think if you look at the macro environment right now, this is more like 9/11 than it is 2000 or 2008-9. This is, we've been punched in the gut by something that we couldn't control. And that's going to have a market effect. There's going to be a lot of job loss. There's already been 3 times the job loss, I believe, already than we had in other downturns. So there's job loss. The question is, are these jobs going to come right back? Probably not going to come right back. So I think technically we're going to go into a recession. Question is how long. Usually the deeper the drop from something like this, the longer the recession. But we're going into I think we're going to go into a recession. At least you have to think that that's a real possibility. So what you have to do is you have to start thinking about, how am I going to operate in a recession? And from my experience, if you're in a business where your customers now are less likely to buy your product, if you're going to have to go and significantly reduce your revenue projections, if you're in industries where, for whatever reason, you're not going to be able to accomplish what you were going to accomplish, also, you're probably not going to be able to raise money easily or at valuations that you would deem attractive. So my advice is in those situations, what's normal is entrepreneurs will tend to cut less than they should early on. So they'll cut a little bit and then they'll have to cut more, and they'll cut more as they get into an environment where they're having a tougher time. So you're not going to grow your way out of this problem unless you're lucky enough to be in some of those industries we mentioned earlier that benefit from a pandemic situation like this. Unless you're in one of those industries, and we have a bunch of examples of companies that are benefiting from this, and a lot of companies that are being significantly harmed by this. And what you have to do is you have to think about, don't force revenue, don't force growth. I mean, you've been told for the last 10 years, grow, grow, grow. That's how you build a valuable company. Now you're going to be told, wait a minute, one of your biggest assets other than your people and your know-how is your cash. Preserve that asset. You have to survive before you can thrive. So you have to get through this. So what I'm telling my companies is, you want to cut a little bit of fat. You got to cut all the fat. You're going to cut some muscle so that you don't have to cut bone later. That's really the kind of environment we're in now. I don't want to be an alarmist. And I think there's a big difference between fear and panic. Fear can cause you to operate in a deliberate manner and can activate you and get you to really understand what your threat is. Panic is not what you want to do. Panic is when you make bad decisions because you think things are either worse than they are, or you don't have the ability to control your own emotions. So this is not a time to panic. We're going to get through this. It's just a time to be, really introspective and thoughtful about what this means for your business, how you preserve cash. And I can give specific examples, unfortunately, about companies who are going to have to, one minute they were exceeding expectation and they had a great fourth quarter. And then the next thing the revenue for this year looks like it could be significantly below last year, and nobody likes that. And they grew their employee base by 25 to 30%, and they were expecting to grow another 20 or 30% this year. That ain't happening. It's not happening in most industries, I would say. So I'll stop there, but that's the kind of environment we're in, I think.
I want to underscore 2 things that Todd said that I think are like double underscore boldface. One is growth. We've been in this environment where the only thing that investors seem to care about, public and private market investors, were that you had a growth rate that exceeded some level, and the threshold has been 100% year over year. There was this incredible focus, independent of all the other economic characteristics of your business, on if you're not growing 100% year over year, I don't even want to talk about the other stuff. I believe that 2020 is going to be like that baseball season or that sports season that didn't finish. It's going to have an asterisk next to it. no one is going to pay any attention in the future to your 2020 top line number. And the growth characteristics, assuming that we manage our way through this reasonably quickly, will be 2019 to 2021 versus 2019 to 2020, 2020 to 2021. So just thing number one is near-term growth doesn't matter. The subset of that, which is also important, is I believe that, and it sort of was said a little bit earlier, venture investors and public market investors are sort of in different cycle dynamics around this, but they tend to ebb and flow with regard to top line of your business and then the actual economic characteristics of your business. And long term, if you're in business, you need to generate positive cash flow. And theoretically, if you're a finance person, the value of your business is the long-term discounted cash flow of your business and ... We have not been, as a high growth entrepreneurial segment, operating with those principles at all. And at the early stages, you don't, because most early stage companies are trying to grow to get to a point where they actually are in a place where they can have some long-term meaningful economics that makes sense. On the other side of this, I think you will see a lot of investors, public market and private market investors, pay much, much more attention to the foundational economics of your business, especially if you are what a lot of people have been saying subscale, but where you could be at a scale where those economics have clicked into gear. So sort of getting a pass on that stuff is not going to be as easy. And so instead, back to this moment, use this time to fix that. Cut the fat, cut aggressively ahead of that, fix the problems that you know your business has proactively. The other part of it has to do with cash. My partner, Seth Levine, has a line he whips out regularly. It's a cliche like the, don't ever waste a good crisis. His version of it is, no one was ever criticized for overreacting in a crisis. So, if you're in a place and overreacting, again, to Todd's point, not in panic, but in the choices you make. Cut deeper than you ordinarily would. If the length of time is shorter, no one's going to criticize you for cutting deeper if you preserved your cash longer. The most valuable thing many companies have today is their balance sheet. And if you can put yourself in a position so you have much more runway ahead of you with very, very low assumptions about what's going to actually happen in your business, both revenue and cost structure, you're setting yourself up so that when things get better, you'll be in a much stronger position.
Brad, I want to drill on one thing you said about having this year sort of not count against you. There are some companies that didn't have revenues last year that are hoping to raise a seed or seed plus round later this year. And, they have something of a business. I mean, I was just talking to a company that had just raised a seed round and has some cash in the bank. And we're looking out at saying, okay, well, if we wanted to raise in the fourth quarter, we don't have any fat, we hardly have any employees, and growth is really like the only story that some of these companies have. How would you think about, a company that just raised? I mean, should they essentially mothball for a couple of months and then?
No, but I disagree with the premise that the only thing that they have to show is growth. Because, for example, there's an enormous amount of progress you can make without actually generating meaningful growth if you're a seed stage company. And that's something that will appeal to investors in terms of the quality and the validation of your product. And you don't have to add a lot of people for that. And so really it's changing your focus, right? I mean, normally with growth, well, obviously some of growth is, generative, you go and get the growth. A lot of the growth gets primed by spending money on stuff to try to get the growth. So you use your money to get that kind of growth. I would put yourself, if you're an early stage, seed stage company and you have cash in the bank, first analysis is, how long can I live with the existing team with the cash? And is there anybody on the existing team that shouldn't be here? The next thing you can do is go to your existing investors and say to them, look, we have no idea when the financing markets are going to be available to us. Do you have any more cash for us if we make progress? And what kind of progress do we have to make for you to have cash for us? And, having gone through a couple of downturns, that's a very natural type of financing that happens at the seed stage. it's not necessarily valuation attractive to a founder, but it's a way to continue to make progress. So you may as well understand if you've got 3, seed stage VCs and they all say, nope, I'm one and done, I don't have another round for you, then If they all say, well, if you make progress, then we'll give you, a check of the same size. Then you can ask the question, well, what does progress mean? And let's define that together so that I'm using you to help me understand what my baseline is. And the last is, we've had this conversation across our portfolio. I don't think you should make assumptions about when you can raise money again. I think companies might be able to raise money again in 1 day, 1 month, 3 months, 6 months, 12 months. There's plenty of deals getting done right now. I mean, we have a company that is a seed stage company that is spinning out of another company that just got a lead term sheet today. So there is activity, but I don't think you can predict that activity for 2 reasons. One is it's situational, and we don't have any visibility to how this is going to play out. So I'm reasonably optimistic. I think, there's an optimistic bent in Todd and how he described timing. The optimistic timing is that in the United States, we will get through this and we will have a reasonable summer. The pessimistic view, which you don't have to read very far into the news to see, is that in the United States, summer is going to look like Italy looks right now. And I don't believe that's going to be the case, because I think that in the US, when we kick into gear, we can really kick into gear in a serious way on things. And I think people are working hard at it. But I wouldn't base any future predictive decisions on that, right? So back to what that early stage entrepreneur can do is recognize that you have an indeterminate amount of time versus try to optimize for a determined amount of time. Something I think that a lot of entrepreneurs have been doing, certainly the last 5 years, because you're like, okay, well, 12 months from now, I'm going to raise my next round. So by September, I have to do this. And by December, I have to do this. I think that's a lot harder to anchor on right now.
Let's just drill into cuts for a moment. Some founders are trying to make...
I think people could probably stop doing food in their office for lunch and dinner.
That's pretty safe. Unless they're quarantined in their office, and then they're going to need some food. Sure. But people are wondering what they should optimize for in terms of cutting, because there's some element of like I'm trying to keep a team together. In some cases, you're worried that if there's some employees that I just don't want to lose. There are other considerations of, there are probably some employees that you could afford to lose because you might be able to hire better in this environment. So like, how would you be optimizing cuts? How are you advising a founder to walk through and say, where is that line between muscle and bone? Todd?
Well, I think you have to look at cash. I think you have to say what cuts will optimize my cash position. Then there's always that teeter-totter of, well, am I cutting something that's going to optimize my cash position, but it's going to undermine my future competitiveness and value? And I would say the future is now. Let's make sure that we survive. Let's make sure that we cut enough so that we have the runway. Plus, if you're going to go out and raise money, and by the way, you'll be out there. It's not like there's no money out there. There's $20 billion of dry powder. VCs know, because they've seen the numbers, and we all look at the numbers. We're guilty maybe of one thing called pattern recognition, and we've seen the pattern where this is when you create the most meaningful companies and have the biggest realizations is during periods of disruption like this. When the market's down, you're able to get maybe own more of a company at a time when things are tough and there's fewer companies getting funded, and then they rise and they're more unique. So for VCs, they do want to put money away. They've got it in their pocket, and they also know that this is a good time to invest. So there is money out there, but they'll also be looking at you saying, all right, you have a $5 million, you have a big burn. You have a big monthly burn, and you're not going to have revenue for a while. So, I want to know that if I put money in, you've got 2 years of runway, because I don't know how long this is going to last, this situation. So I want to make sure I'm going to give you enough now for 2 years of runway. And if you're burned and the amount they can give you doesn't equal 2 years of runway, I think that's not a good equation.
And I think it's probably fair to say too that, you know, having that plan for 2 years of runway, if things turn up, doesn't necessarily have to be the plan. If you are seeing growth and profit coming back to the company, you can cautiously accelerate, and you might even be able to get a preemptive term sheet before the next round. But just at least knowing that you have that plan in your back pocket, I think is
yeah. The other thing is we're in at least a two-phase situation right now. And this phase we're in now is this phase because of the virus and because people are forced to stay at home and people aren't buying like they were, and there's massive disruption in hospitality and travel and all that. So that's one big one. But then when that's over, and it will be over at some point, you can argue, I'd argue it's between probably June and September, it should be largely over. Then after that, you're still stuck in probably a recession for a while. So it's not going to be like all of a sudden, you know, the pandemic has left us, but now everything's hunky-dory. I don't care how much money the government pours in. It's not going to fix everything. And it can't. They only have so many tools. Interest rates are already close to zero, so they can't go much lower. And they can pour money into some businesses, but mostly what they're doing is they're giving people fish. And once you eat the fish, you know, you're hungry again, rather than giving them fishing rods. That's the problem. But anyway, so just because you get through this period of the pandemic doesn't mean you're going to come out the other side and everything's going to be rosy. You still have to worry about how you're going to survive through what could be, you know, a couple of years of a tough market.
So one of the reasons why I asked you guys on out of all the other VCs is because you've been around difficult periods before. Did any success stories from prior downturns come to mind, or any kind of commonalities where you can point out and say, hey, here's a few things that worked or that were common to people that made it through?
Charlie, would you rather have generic or specific?
Specific is always great, but you know, general is okay if you don't want to name names.
Now, I'll give you a specific that can be generalized. We had an investment in a company called Postini. Postini was, I think we invested in it in 2001. We invested in the Series D, which is very unusual for us because at the time we were usually investing earlier. And the Series D was the lowest price per share round for the company. So it was, you know, a very significant down round for the business. But what we saw as investors in that moment was a founding team that was a year or two ahead technologically of an emergent problem. And the emergent problem was spam. And as investors, we knew that spam was an emergent problem because I've been investing in internet email since 1994. So we had prepared minds for it. The other investors at the time were all unwilling to put more money in the company by themselves. And the company found us through a variety of things. One of my partners, Ryan McIntyre, who was one of the founders of Excite, was very tuned to this problem. I was very tuned to this problem. And we invested sort of at the tail end of the collapse, right? So it wasn't at the very bottom of the collapse, but it was collapsing. And it was the point at which almost all VCs had stopped investing. The interesting thing, Scott Petrie, who was the co-founder, technical co-founder, he was very clear that they had started to create this business that had an aperture that probably looked like this around what they were doing. It had mobile in it, and it had just a bunch of things. And what they did was they changed the aperture so it was very narrow. And they picked one of the portfolio of things that they had previously been going after as their platform around, you know, email and email management. Again, go back to 2001. This was pretty innovative stuff. And they narrowed it, and then they said a very specific thing, which is they said, the problem is we don't think when people come out of this, they are going to be able to deal with managing this problem across all of the different computers and infrastructure and technology that they have. So I think that the end result was that they created a cloud-based anti-spam product that became very successful. They built a sales engine that was very low cost, so it ended up being very successful. They had several competitors who they left pretty much in the dust in terms of it. There were other companies that could have easily done that, but then didn't pay attention to it because they chose not to prioritize it. And in the end, Google bought them just as they were going public, and they became a core part of the Gmail infrastructure. So and it was a $600 something million acquisition, which was a big number in 2000 and whenever it was acquired, 2005 or 6.
Especially probably relative to that fund size.
No, it wasn't, because the fund size was $1.25 billion fund. It was one of the Mobius funds. I mean, it was a good exit, but it wasn't. Yeah. The generic thing they did was they took their ambition, which had been funded on the beginning of the ramp up of the internet bubble. They narrowed their ambition so it was very focused on a thing that they had now high conviction was going to be a future issue. So they didn't keep their options open, they focused. And they found an investor in us that had a prepared mind for what they were trying to do and why they were trying to do it. And I think that's really part of the key.
Gotcha. Todd, any lessons come to mind?
Well, I mean, Brad remembers AdMeld, which kind of went through the whole, 08, 09 situation, came out the other side. It was a good, quite a good result. It's because they really kind of knuckled down, and it was less about generating revenue. It was more about trying to create a, market share. It was trying to get market share and, and break into the whole real-time ad trading space and all that. So that was an example. Twitter is another example there. It wasn't so much growth in revenue. It was more about, all right, we raised a bunch of money. We think we can still raise money. How do we, kind of control cash without giving up on our vision of being this broad platform? I think one thing they benefited from is when news is bad, they tend to do better just because there's more, attention, more communication, more social communication. So those are just a couple of examples. But I think the other thing that happens is, entrepreneurs and VCs are kind of in the same boat right now. They both want the company to be successful, and they both are in a situation where they realize we're in tough times. Now, yeah, the entrepreneurs are the guys rowing the boat, and the VCs are in the back going, row faster, and don't eat so much of the hardtack. We got to go a ways here, but it is the same boat.
There's a word that I don't know if it's a made up word or not, but it pops out in our partnership every now and then, which is the word decomplexify. And it's a word that's delicious to me because it's so sort of complicated in what it's trying to say. And what decomplexify to me means is, in these moments of real distress, economic, and in our case, it's a healthcare crisis that is precipitating an economic crisis, not an economic crisis that's precipitating a healthcare crisis, right? So we recognize that, and Todd said this really well before, we have two things going on. We're dealing with the healthcare crisis. The result of dealing with the healthcare crisis in real time is it's generating an economic crisis. We have to solve the healthcare crisis. Bill Gates had a good line the other day in response to something that I saw, which is, he says, look, we can, long-term, you can deal with the economics of a society, but you can't bring somebody back to life. And, it's sort of a blunt statement of saying, we got to solve this one. And it doesn't mean we can't work on this one too, but we're not going to solve it. It's going to just get to some state, and then we have to work on it. As a business owner, as an entrepreneur, if you decomplexify your work world, you get rid of the optional. You have less people that you have to interact with in terms of the span of control. You recognize the reality of what you have today, and you try to give yourself more time to be able to then do the things that are really going to have impact when we can get to the point, or when you can get to the point where your business starts to work again, or where our functional economy starts to have an engine again versus all of the energy going against the healthcare crisis. You put yourself in a better position.
Yeah, I agree. I think this is a time.
Somebody texted, is decomplexify the same as simplify? Of course it is, but I like the word better.
I like it better.
It makes you think.
Yeah.
Todd, go ahead. You were going to make a point, Todd?
Go ahead, Todd. Sorry, I cut you off.
No, that's okay. I think I forgot what my point was.
That's totally
I
fine.
decomplexified Todd's point.
So I want to talk about, before we look through some of the questions here, downstream, well, upstream pressure in terms of perception of not only exit valuations and multiples, but LP pressures. You know, obviously, if you're at a fund that just raised, you're probably feeling good. But, you know, if you are going back out into the market this year, it may be sort of a difficulty. You have some funds that are mid-raise. How much is the money coming from the next person down the road creating pressure in this market, either in terms of how VCs deal with existing portfolio companies, like maybe more of a willingness to shore up the positive companies so they don't go bust before the next fundraise? Or on the other hand, maybe I remember I was fundraising for a startup the week that Lehman went under. And I remember a VC telling me that there was no point to investing in my seed round because he was going to have to raise before I could ever see an up round, and he just wasn't going to get any benefit in the short term from investing in my seed round. So he was just going to focus his time on his existing portfolio because he had to go back out and raise in the next 9 months. So how much is that pressure changing the VC equation from LPs?
Well, I'll give my two rules of shit. One is shit flows downhill. And the second is, if you have to eat shit, eat it in big gulps. Okay, so those are the two rules of shit. And what that means is that if VCs that means if you're not able to take your companies public, and the companies that are public, they've been depressed and they don't feel as comfortable making acquisitions, that means exit values are depressed, which means that depression, that shit flows downstream to the point where everybody who's raising money is going to have an impact on their valuation. That's number one. And the second rule is, at a time when you're facing doing something you don't really want to do, you have to be really uncomfortable that you're too focused and that maybe you're cutting too deeply. And that's my second rule of shit, which is eat it in big gulps. Make the cut early and make it to the point where you're really uncomfortable. And then, as Brad alluded to earlier, he's absolutely right. And then focus what you do to the point where you're really uncomfortable. So get really uncomfortable about focus and about how you're operating your business.
How should founders think about valuations? And I guess that's partially sort of an answer to this question is, there might be companies that have still experienced some growth from where they were the last time they raised, but people have been saying for a couple of years now that valuations are over their skis. Now I'm going back into the market, facing a down round. Is it just, raise at the highest price you can get? Is it worth trying to delay a raise as long as possible in hopes that valuation comes back? I mean, how do you balance, I need cash to hit my end goal, but man, this is a really painful environment to raise. Maybe I should just put it off.
Well, I separate from whether you can put it off or not. Like, if you are in a position where you don't have to raise additional capital in the next 3 to 6 months, awesome. And, I think, if you have capital, try to figure out how to make your capital last 18 to 24 months. And, we're sort of talking about 2 years. And if things change, then you can benefit from things change because you don't have to have an absolute plan. Of course, if things start to become positive, you'll increase your spending and you'll go raise more money. So like, if you don't have to raise capital, spend your time on the other stuff, but make sure you have enough capital so that you're not finding yourself in 3 or 4 or 5 months changing your mind about having to raise capital in the near term. There are lots of companies that have to raise money right now. There are lots of companies that are in a position where they don't have a lot of extra capital. And I think the worst thing in the world you could do right now in any scenario is optimize for valuation. Like that's just why? You optimize for valuation, you're putting the wrong thing at the top of the stack. That doesn't mean that you should try to generate competition in terms of your financing. It doesn't mean you shouldn't be thoughtful about how you're presenting your business. But I would suggest, again, another cliche that gets thrown around. I think I see it too often from random people. It's like, you should value your investor or the quality of the investor over the valuation you get. It's actually kind of true right now. Like if you have two choices, you have an investor who's not going to be able to help you or could be harmful to you based on their behavior, that's willing to give you money at a higher valuation than somebody who is well known to be able to be a firm to be helpful to you through these periods of time. Which should you choose? And I don't know if Todd had this experience in the internet bubble. I had 4 public companies that I was on the board of at the peak. As things fell apart, many of those, I think all of the public companies except one had to raise more money. And there were numerous investors in the public markets that were willing to give you higher headline prices, but with terms that if things didn't work, you were truly fucked.
Remember the toxic convert?
Totally. I was just as an example, I was co-chairman of a public company that raised a convertible debt offering that was able to be done in 3 days because it was unregistered. This is a toxic convert version of it. And it automatically converted into equity when it traded up, the stock traded up 15%. Merrill Lynch did 30 deals like that I'm aware of. 29 of those companies, including the one I was on the board of, went bankrupt because that debt never converted to equity because the stock's highest trade was before the debt deal closed. And because the buyers of the debt also shorted the equity. And of course, our market was going like this. And like in the end, it was a terrible financial instrument for companies that had no business trying to raise it. But I could raise in 3 days this debt at all this money. And the equity, maybe it would be more dilutive. So just be thoughtful about the resources. And again, don't optimize for things that are not important in this moment.
Do you guys think
Spiral Convert somebody wrote? That was another line for these. There are hundreds of this kind of nonsense. It's going to come around again. Look,
oh yeah.
It'll be there.
Do you think that the appetite for what types of companies wind up raising, or what companies get started during this period? I feel like I've seen a bunch of knee-jerk reaction deals where somebody came up with an idea in the last 2 weeks that like works really well for an environment that everybody works from home, but doesn't really take into consideration, a return from that. I mean, we saw, Blue Apron is up 6x in the last couple weeks, and I'm not sure what that is going to look like when everybody leaves their house. But do you think there are any fundamental shifts in terms of better, faster, cheaper, for example, in a recessionary environment that you are looking at as trends?
Well, I think that what this is this whole disruption here that's being caused by the pandemic and then the after effect it's going to have a profound impact on education. I have a freshman who was sent home from college, and she's taking all of her classes online, and that's happening across the country. And it's going to force people to be more open to it. It's going to create opportunity for those that can deliver that. So I think that's just one example of what you're going to see. The whole kind of virtual teams. I have one company that's in stealth mode right now that I've been nervous about because it was a total virtual team. And I felt like, I don't know, I'm kind of used to a company that they go there and they stand around the cappuccino machine and they talk and they're hanging together and all that. And at this very moment, I can tell you, I am delighted that that's a virtual team. But this is going to be over at some point. And then the question is, are people going to go back to normal? So I think, like the guy selling the fitness equipment now for the home, that is spiked right now, but is that still going to be the case in Q4? I think there'll be a lingering effect from this. I think people will be maybe a little bit more nervous about going into public places and touching things. I mean, that could be the case. But one thing that I think will be profound is the ability to do business, whether your business is education or whatever, to do that remotely from your home and to do that electronically and online.
I've spent very little time thinking about the opportunities that come out of this. And so, although I agree that there are going to be complete broad changes in things, I think there will be very broad changes in education. I think there will be extremely broad changes in, especially in the US, and how our healthcare system works. I think that there will be lots of changes. We've been having this enormous backlash against data and privacy. I think there will be a huge recalibration of all of that as a result of this. I'm not going to predict what those recalibrations are, but like those are categories that have broad swaths of opportunities but I haven't thought about what's underneath that. I would assert that I don't think we go back to normal after this. Like, I don't think this goes back and we snap back to the way we lived our lives and the way we experienced our reality as a society in 2019. It doesn't mean that many of those things won't be the same way, but I think there's going to be many new things that people are going to be comfortable doing that will create changes in the way we interact with each other. And, look, Todd and I lived through this too, is that in 1999 and 2000, we both believed that everybody would live a certain way because of the internet. And so we were investing like crazy based on that premise. In 2002, there were, and not just in personal, but business. In 2002, 2003, there were, a repudiation of that belief. By 2015, that belief that we had in 2000 was happening.
Yeah.
And we were just in a moment in time where the technology wasn't there, the infrastructure wasn't there, and the human behavior change wasn't there. And from my frame of reference, I think there were a number of technologies that converged, and the moment that created the tip was not the 2007 introduction of the iPhone, but the sort of time frame around that. As over a 2 or 3 year period, that became a generational shift. I think the difference this time is that the shift is happening in 3 months. And so the fact that our entire society is having to learn how to telecommute, video conference, interact remotely, work remotely, deal with other human beings without being physically in the same place, go across geographic boundaries and time-based boundaries to solve problems on a rapid basis. These are all none of these are new things. These are all things that we've been doing, but all of a sudden, all of our society is doing them. And so the ability to come back on the other side and have those be a normal part of the way we interact, I think is going to be really transformative. But
I agree. I think, so we were investors in Oculus, and if you had told me at the time we invested in Oculus that this was going to happen, I would have told you that we would all be sitting in our homes right now with headgear on, and we'd be as if we were together in the same place. That hasn't happened. VR didn't happen the way we kind of thought it was going to happen. But as Brad said, it will. Next time this happens, and I hope it doesn't, but it will. Next time something like this happens, we will be sitting in our homes or wherever, in our bathrobes with the Oculus gear on, or some other manufacturer, and we will be having a virtual conversation. We'll be able to look around and see everybody as if they were here. So it's just that kind of presence, the same thing that you get when you are in a room with other people, is going to get replicated so that you don't have to be in that room physically to get the benefits of being in that room.
One quick, small practical question before we let you guys get back to work. If I was going to pitch your firm and was working on my deck a couple of weeks ago and now was sort of ready to do so, Brad, you pointed out, obviously we have priorities as a society. We need to sort of get past the health crisis before we start thinking about other stuff. But is it Is it bad to pitch now? I mean, do you get a pitch? Do you look at that founder and say, well, what are you doing, dude? Like, aren't you focused on helping the guy next door? Or is it just more like you probably not going to get to that email a little while and you might pick it back up and you're not going to sort of hold it against somebody?
I wouldn't hold it against somebody. Anybody who sends me something right now that looks like a new inbound pitch, I respond and say, I'm not looking at anything today. Send me a note after April 15th. And I just know I have no capacity to do anything, but I'm not going to hold it again. And then I archive it. And if the person sends me back a note after April 15th, I'll re-engage. Like, I would say the ability to get somebody's attention for something that they're explicitly not focused on right now is low. Mm-hmm. But if somebody, I just did a call with a company that I'm not an investor in. It's indirect through one of our partner funds. They wanted me to spend some time with them. They're about to start a fundraise. And I was happy to prioritize that because I had a relationship with the partner. We are investors in the partners fund, and we want to try to be helpful. So I just give that as an example. Like the priorities, if you're trying to get someone's attention, the referral dynamic right now is almost essential. And at the same time, if somebody has no capacity and you're aware that they have no capacity, be respectful of it. And on the other side, sure, I imagine there's some people who will think that it's tone deaf that somebody's sending a note out. I mean, every day I'm getting in my inbox, because of the state government stuff I'm getting emails now from people saying, I have this business that solves the pandemic crisis because it allows you to, blow your nose remotely. I'm like, the investment banker sending hey, we have an opportunity for you to put $2 million in at the end of this financing. It's a special deal. It's like, don't play that game as an entrepreneur. Try to make the value and the dynamics more authentic. Right?
Gotcha. Well, listen, guys, thank you so much for making the time. I really, really appreciate both of you spending some time with us. I think everybody got a ton out of it and really, really appreciate it.
Charlie, thanks for organizing. Todd, tell your gang hello.
Yeah, I will. Same to you.
Yeah, I will.
All right. Thanks, everyone.
Take care. Be well, everybody.
Be safe, everybody.
Wash your hands right after this. All right. Bye-bye.